Look at a map of the global economy. It looks vast. It looks invincible. A web of trade connecting billions of people, trillions of dollars, and endless supply chains. But the architecture of capital is actually incredibly fragile. If you strip away the politics, the borders, and the news headlines, the entire system relies on a few tiny, narrow waterways, the veins of the earth. And right now, those veins are being severed. Welcome to a special briefing. Today, we aren't looking at the stock market. We are looking at the ocean. Because the events unfolding in the Middle East right now are not just a regional crisis. They are a mathematical guarantee of global inflation. 30% of the world's container traffic passes through the waters of the Middle East. It is the bridge between the factories of Asia and the consumers of Europe and the Americas. But when instability strikes the region, the math of global trade breaks down. Right now, the world's largest shipping conglomerates are abandoning the fastest routes. They are rerouting thousands of ships around the continent of Africa. This isn't just an inconvenience, it is an economic tax on the entire planet. When a voyage takes 2 weeks longer, it burns millions of dollars in extra fuel. Insurance premiums skyrocket by 400%. And who pays for that? You do. In economics, there is a simple rule. If it costs more to move a product, it costs more to buy the product. This is what the financial media is missing. They are waiting for inflation to cool down. They are begging the central banks to cut interest rates. But you cannot cut interest rates when the physical supply chain is broken. When global choke points shut down, supply drops. When supply drops, prices gap up. This is the exact inflationary catalyst that the historical cycles warned us about. If you remember our masterclass on the 1875 Benner cycle, a massive shock is required to end the years of good times and trigger the 2026 peak. The instability in the Middle East is the match, and the global supply chain is the powder keg. The central banks of the world are now trapped. For the last 2 years, they have held interest rates high, trying to kill inflation. They promised the markets that cuts were coming, that the pain would end soon. But the geopolitical board has flipped. Because of the chaos in the shipping lanes and the threat to the energy supply, inflation is sticky. It isn't going away. Which means the central banks cannot cut rates without destroying the currency. They are forced to hold rates higher for longer. And that is what breaks the system. Remember the second economy, the physical world of corporate debt and commercial real estate. Corporations and real estate developers have trillions of dollars in debt maturing over the next 24 months. They were desperately waiting for the central banks to cut interest rates before they had to refinance. They were waiting for a rescue that is no longer coming. Because the supply chains are choked and inflation is returning, interest rates will remain punishingly high. When these corporations are forced to refinance their massive debts at today's rates, they won't be able to afford the math. The bankruptcies will begin. The dominoes are perfectly aligned. Geopolitical chaos chokes the supply chain. The supply chain drives up inflation. Inflation forces interest rates to stay high. And high interest rates crush the debt markets. The 2026 convergence is not a theory. It is happening in the shipping lanes right now. But while the public panics, the smart money is already executing their head. If you want to know what the billionaires are buying while the ships turn around, hit subscribe. You are watching The Architecture of Capital,